want to thank everyone for joining us live, and I will come back and give everyone the chance to ask questions. But I do want to get some content rolling here. So the goal of this is to really, as much as we can in an hour and a half, try to really teach you what our strategy is, why it works so well, the pros and cons of it, and more importantly, just how to follow the program. A lot of you guys really don't want to do all the research. You really just want to make the trades and have consistent income. So I can understand that. And so if you do have any questions throughout this initial part, post it in the chat box. I have it open on a different screen, and I will take a break in a little bit to ask who has questions and to unmute everyone once again. Okay, so let's get started. Our goal is to create income for retirees, and we do this with the daily income trade alert at noon Eastern. The target goal is to generate 1% per month. We've had some months where we're above that target. We've had some months where we're below that target. What I can tell you is I'm much more concerned with losing money than trying to achieve the 1% return. So if there is any type of risk in the market, I will play it safe and not take any risk that could result in a large loss. So the result of this is we've only had one losing month, and that was a loss of 1%. That was back in July, and I was predicting that the trade war would escalate. Guess what? It escalated in August, so I was 1 month early. We picked up a nice return in August, but we lost 1% in July. In a 90-day period, we've never lost capital. So that's why large portfolios primarily are very attracted to our service, as they have enough capital to really make this worthwhile. And they're also very smart. They don't like to lose money, and they're not greedy. So that's really who is very attracted to this program. So far, our average return is 1.35. But again, when there's a lot of uncertainty in the market and there's huge amounts of risk, expect a lower than 1% return. When things are a little bit more dead obvious and there's not as many potential potholes in the road ahead, we can actually perform above 1%. This is our current trading schedule, which we're going to talk about really 3 outcomes in the near future. So we have really 3 different market environments we have to trade. One is where the trade war is up in the air. We just don't know what's going to happen. That's very hard to trade. The second outcome is when the trade war is escalating. That's far easier to trade. And then the last outcome that we have to deal with is a de-escalation. And that, once again, is very easy to trade. So right now, the trade war is clearly up in the air. We just don't know what's going to happen next. And give it 2 hours, you're going to hear conflicting views. 1 minute, we have President Trump bashing China in front of the United Nations. We have Pence talking about how they have concentration camps and associating them to Hitler. And then the next breath, we're on the verge of a phase 1 trade deal. So it's very hard to predict what will happen next. What we do know is that no president has been reelected during a recession. So we know that Trump's highly motivated to create a deal to avoid a recession. But on the other hand, the Chinese know this as well. So if they can just bear the pain for another year, they might have someone that's much more pro-China, like Michael Bloomberg, who just threw in his official registration to run for president, or Joe Biden. Okay, so let's take a look at this. Currently, we are slightly overweight in equities, the 52% asset allocation, trading the SPY ETF Monday, Wednesday, Friday. Now in this presentation, I'll tell you what the heck the SPY is, but I'm sure most of you already know that. The biggest benefit of the SPY, besides being the biggest fund in the world, when I started this program, it had $140 billion in assets. It's grown to $260 billion in assets under management. And now a lot of that's just capital appreciation, but it's still the most highly traded security in the world. And it's the only equity that has 3 option expirations a week. So if you like to write covered calls, the SPY is really your hero product for doing that. I consider it the bread and butter of the entire strategy. And as you'll see, we can actually profit in 3 directions on the SPY by using the option market. Emerging markets represents about 1/3 of our equity portfolio relative to the SPY, and it has 200 shares. Emerging markets is a much riskier asset, and it's actually a basket of 1,000 companies that covers most of Asia. They've left out Japan in that index. It's primarily just China and all of China's trading partners. But 2 of those companies, primarily Alibaba and Tencent, are in the top 10 most profitable companies in the world. And plus, they are benefited from the government of China. And now we'll see that's a double-edged sword. Because when things are going good for China, they're able to help these companies dominate. But when times are bad for China, they like to pull what's working, take the profits from those companies, and try to help out the parts of their economy that are failing. So that's the good and the evil of investing in China in terms of risk to reward. The TLT is your 20-year treasury, 20-year plus. And again, that represents the tax receipts of 350 million people, the biggest GDP country in the world, representing around 25% of all GDP, and plus all the corporations. So although it seems like it's just 4 ETFs, you have an extremely diversified portfolio. And more importantly, is each of these assets are highly uncorrelated. Now, sure, the SPY and emerging markets tend to go up and down in tandem, but that's not always the case. And you can go look at 2017 through 2018 to see a very distinct separation of paths where the SPY went up and emerging markets went down as the trade war began to escalate. Meanwhile, we have GDX. That's our gold miner ETF. And that's about 100 different companies, but most of it is held in just a handful of companies that actually have access to capital to mine right now. Now, note that I have a plus sign next to these 3 and a sideways sign on GDX. This represents that we basically want to be bullish on all of the plus signs, and we're relatively neutral on gold. And that's our position stance, our default position when the trade war is up in the air. And this is during a period where central banks are lowering interest rates. We have 60% of all central banks lowering rates. More importantly, we have the 3 biggest banks lowering rates, the Fed, Euro, and China. We have low inflation, at least according to consumer consumption, the way they've altered the CPI to keep that level low. So as far as the Fed's concerned, there's no reason to raise rates. And now we have quantitative easing. In fact, the amount of quantitative easing that's hit the balance sheets in the last 2 months is coming in at a faster pace than QE1, QE2, QE3, and QE4. But if you listen to Jerome Powell, it's not QE. So what exactly is it? It's a faster pace of buying up debt from the government than we've ever seen in history. So it is a bubble that is forming. And as long as there's no little pins to prick it, this is our current strategy. So we're playing the SPY, the emerging markets, the TLT, and GDX. The problem is these circumstances can change quickly, and we've seen it changing. So let's go to the next slide. When the trade war is escalating, we've seen a very quick response. Stocks sell off, bonds and gold rally. So as you'll see, we're actually able to use the option market to buy and hold the SPY and emerging markets, and then profit from those assets going lower from the option caller. And I'll show you that in a minute. But it's actually more profitable for us when the trade war escalates because we benefit from the change of price and being able to predict that. So it's quite clear every time the trade war escalates, stocks sell off, bonds and gold go up. Okay, the third potential outcome is the trade war de-escalates. The Chinese really want us to roll back all tariffs, to forget about the trade war altogether and go back to how things were. That's really what they're pushing Trump to do. I think there's less than a 50% chance this happens, but we have to be aware that it is possible. And in fact, we continue to have both sides say they think a trade deal will happen, at least the phase one trade deal. In these circumstances, we're seeing that bonds and gold will sell off and equities will rally much higher. And that's, again, because we have low rates. And more importantly, we have rates that are traveling lower. We have low inflation, so there's no pressure to stop this easing cycle. And we have quantitative easing. How much quantitative easing? We have $60 billion a month committed to the second quarter of 2020 by the Fed. And in Europe, we have 40 billion euros a month. Japan's ready to use as much quantitative easing as necessary. And now we're seeing the Bank of China also start to lower rates and do some minor repo, about $20 billion overnight right now. They have slowed down their QE, but that's because they're just in so much debt, they're having trouble dealing with it. Okay, so those are our three outcomes of how to deal with the trade war. Now, we're not changing the underlying assets, we're not changing the schedule, and we're not changing the ratio. So these all stay put. So for every $75,000, just multiply it. If you have 150,000, you would do 200 shares of the SPY, 400 shares of emerging markets, etc. Now, really quickly, if this makes sense, please let me know in the chat box. If it does not, let me know so I can pause, I'll unmute you and make sure we're on the same page. Because before I go to the next slide and teach you how to benefit from down moves in these assets, I want to make sure we're crystal clear on these three slides. Okay, Jeffrey says he's all clear. Manny says he understands so far. And if you haven't found your chat box, it's in that little toolbar so that you can go ahead and click that and let me know if you're confused at all. Now, if you're confused, don't be shy. There's probably a few other people who are confused too and just don't want to admit it. But that's what the point of this is to ensure that we're all on the same page. Okay, Don Nelson understands. James Hearn understands. And I see a few new people that I didn't get to say hi to earlier. Alex, welcome to the webinar. I'll be unmuting everybody to get to know each other a little bit. But it looks like so far everybody's clear on this. So we have a very clear schedule. We know what we're going to trade. We know when we're going to trade it. And we know which direction we're going to point the trade depending on what's happening with the trade war. Okay, so let's go to the next step. So the next thing you need to know is that we're always protecting each of these assets with what's called an option caller. We're going to sell a call option for income, for a credit, and we're going to buy a put option for downside protection. This is always the case. We will never have these assets naked, ready for massive losses if the market moves in any direction. And there's a high risk in the bond market and equity market, as well as gold market, depending on what outcome is delivered from this trade war. So we have the bullish loose option caller. This is where we sell an out of the money call option, which I call taking candy from a baby. This almost never pays off for the call option buyer and is essentially free money for anyone who has the capital to own 100 shares of the asset. So this is how we act like a landlord. We have the property, we rent it out to the speculator. But that doesn't mean we don't benefit from the asset appreciating. When we sell the out of the money call option, all you need to know is that your potential profit is cut off wherever you sell that call option. So in this example, the SPY was trading at 298, which you can see down here. And I was selling the 301 call. So after we go above 301, I no longer benefit from any appreciation in the SPY. The guy who bought the call option starts to make some money at that point. So my maximum profit is about $2.90 a share in this example. Now on the other side of the coin, and so I would say this is a great trade we want to do. Don says, what's the delta of 301? This screenshot's oh, you're looking at the delta right in here. The delta is often used as a way to predict the probability of that asset hitting those targets. So they would say this has an 18% chance. But we're not using delta at all. As you'll see, this is a much more fundamental-based strategy where we're trying to understand the macro picture to predict the general move of markets. And I'm a big believer in the random walk. There's just so many items out there that we can't predict day to day. It's very hard to get short-term moves in terms of predicting that. But if we can look at the big pressure on the market, we can get the big picture right and then be confident of pointing our trades in the right direction and do very well. So in this example, again, we're selling the call option. In this case, on a loose option caller, I'm selling it out of the money because I want to let my asset appreciate, and I believe it will travel higher. Now, on the other side of the coin, I'd say it's very foolish to sell put options, especially out of the money put options. We don't do that. Instead, we buy the put option. So the call option we sold is probably to a young fellow who wants to double, triple, quadruple his money, who's feeling lucky. Okay, we'll take that bet all day because we really have nothing to lose. The only thing we have is the potential to make a little less than if we hadn't sold it. Most of the time, it's just free money. We're the landowner. We're letting them speculate on our asset. Good for them, great for us. On the other side of the coin, I love to buy put options. Think about not having health insurance right now. And then all of a sudden, something bad happens. It would be devastating. A lot of people don't have any downside protection in their portfolio. So when the next crisis hits, their nest egg is going to suffer devastation. But there's no reason to have that. In fact, in this example, for a mere 46 cents a share, I can have complete downside protection. And all this means is I will get a minimum of $2.95 a share because I have purchased one put option. And even better, I financed it, most of it, about 75% of it in this example, by selling a call option. So I'm taking candy from a baby, probably a young fellow, and then I'm buying downside insurance from a huge bank. Now the huge banks, they sell these put options all day, and they have essentially unlimited credit to borrow to fill the position if they get assigned. So this is a great deal all around for us when we think the market's traveling higher. Any questions on the bullish loose option caller before we go to the next type of option caller we use? Please let me know if this makes sense by responding in the chat box. And if it doesn't make sense, let me know. I'd be happy to unmute you right now and we can walk through it so we're all crystal clear on how a loose option caller works. Okay, Manny says good so far. James, Jay, Jeffrey, Walter, Alex, Bob, Manny, Hewlett. Let's see, we got more people joining in. All clear. Don Nelson. Everybody understand so far? How far out do you buy the call? Okay, so that changes, Hewlett, but typically this will be the most bullish I would go on the SPY. So maximum potential return of around 1%. And it depends. If there's a catalyst coming up that I think could send the SPY up $6, I may not sell a call at all. So what kind of outcome might do that? Well, how about a phase one trade deal where we roll back all tariffs? That would certainly send the SPY much higher, wouldn't it? So it all depends on the circumstances. James Herb says, callers are costing more than what I had expected. Is this seasonal or normal? So the trades we're doing right now, we're paying a premium for put options, and we're taking very little on the call option, James. And that's because I believe there's a high risk of a downward move in the bond market or stock market, depending on what outcome is delivered from this trade deal. Most of the time, we're going to try to finance the downside protection with the credit from the call option. but that's when it's not so risky. So we'll take a look at that in a minute. Okay, let's go to the next slide. This is what I call a tight option caller. Okay, so all I've done is I've squeezed in the width of where I'm selling the call option and buying the put option. Okay, so in this example, our maximum gain is only 93 cents a share, but our maximum loss is only $1. So you can see in the previous example, I could risk losing $3 and make $3. In this example, I can win $1 or lose $1. So if I think the market's traveling flat or slightly up, this trade is great. The market can go absolutely nowhere and I can make $1 a share. So when I think the market's near a top, but not quite ready to sell off, this is a great trade right here. And we've done this quite a bit on the SPY as we've traveled into these nose-bleeding levels. In fact, this is the trade we're in almost right now. Okay, now this is probably the trade most of you are not familiar with, but this is extremely valuable when there's sell-offs. And this is how we can actually own an asset and profit from that asset traveling lower, which may seem counterintuitive. But in this example, we're actually going to sell an in-the-money call. So the call option is at a strike that's lower than the trading price. So we're taking in a huge credit. In this example, $2.19. But then I'm turning around and investing that $2.19 and I'm purchasing an in-the-money put. So that means the put option is at a strike above the trading price. So it's an inverted option caller. And now we stand to make $2 a share if we go below $2.97. Or if the market were to travel higher, we're going to lose a maximum of $1. So these are our three ways to essentially own the asset, be the landlord, collect the rent, and then buy downside protection. And if we think the market's traveling lower, say the trade deal escalates, this will be your best friend on the SPY, and this will be your best friend on the TLT. Let's say we're still up in the air. We don't know what the heck's going to happen. Well, then you want to be more in a tight option caller where you're going to make less, but you're not going to have downside protection. Okay, Jeffrey has a great question. What if you're assigned on the in-the-money call option? We would love that. Let me explain why. So look at this. We're agreeing to sell our shares at $2.97 a share when it's trading at $2.98. Right off the bat, that should be raising alarms because that means we're willing to sell our shares for $1 loss. Why on earth would we do such a thing? Aha, we're getting paid $2.20 to do that bet. So if we're assigned, how much profit do we make, Jeffrey? Assuming we didn't have the put. If I take $1 loss in assignment, but I get to keep the premium of $2.20, what's my profit if I'm assigned? $1.20. Bingo, nailed it. So we actually would love to be in a bearish trade, get assigned the same day, and then have it sell off the next day. Now all of a sudden you're going to make way more than this would indicate. So this is indicating that we can make up to $2 a share if we hold on to the asset and we're just immediately right. But if we happen to be wrong the first day, we get assigned, we get out of the asset, we have $1.20 profit per share, and we're still long the $300 put. And the good news about down moves is it doesn't go straight down. It likes to whipsaw up and then crash down. There's a lot of volatility. It doesn't just drop straight down. So we actually would love to be assigned and then catch the crash because we can now have a much larger profit. Okay, Don is saying that options are changing prices relative to the volatility of the market. And that's true, but the good news is it happens on both sides, the puts and the calls. So we still get a fair deal no matter what. And it still relies on us being able to predict the general movement of the market over a long period of time. And so that's what's going to be the main lesson of this webinar, is how to predict the markets and then put these to use. Yeah, let's just review that one more time. So if I sell the 297 call and the SPY's at 298, the first math you have to do is that I am paying 298 a share, and I'm getting 297 for a $1 loss. But I'm getting $2.19 from the option contract I've sold. So if they use their exercise, if they exercise the option, you get to keep the 219, and then you take a $1 loss. So does that make sense how you generate that profit on the call option side? Okay, great. Now on the other side, if it just goes straight up, your put option is going to lose some value. So okay, so any questions on the three ways we use these option callers? We have the bullish, the neutral, and the bearish. Now, if you've been watching my recent trades, very similar to the neutral, except I have put the put option right at the trading price, and I've pushed the call option above. And that's because I believe no matter what outcome we get, whether it's good or bad in the trade deal, I believe either the bond market is going to spike much higher or the stock market's going to spike much higher. So I don't want the downside risk, but I don't want to miss out on the upside potential. So I've positioned our trades over this period to not allow us to lose much money on the downside, but to be able to make a big profit on whichever asset goes higher. Now, your guess is as good as mine as to what the short-term outcome is of this phase one trade deal. And so I can go for hours about why it might go one way or the other, but at the end of the day, flip a coin, who knows? But right now, there's tremendous downside risk in the bond market and stock market, but there's also tremendous upside potential in one of those assets as well. So we're using this neutral option caller, but we've just shifted it a little bit higher. So we are taking in less credit on the call, and we're spending pretty good premium on our put option. So this is not our normal situation, but we have a very clear catalyst right in front of our nose, and we know that one of these will be a beneficiary. So that's why we're paying a little extra for these callers right now compared to normal periods of time. Okay, any questions at this point, or would you guys like to move forward? Okay, good to go. Jeffrey is leading the crowd on the chat box. Appreciate it. Okay, let's go to the next step. Okay, so now what I'm going to do is just quickly, I think you guys have seen this a million times, but what I want to stress is a lot of people will be like, you know what? I've outperformed you this year. I'm up 20%. Well, if you listen to anyone who's become a billionaire from the stock market and bond market, they don't care what return you're making. All they care about is the risk versus the reward. So if they look at your portfolio, the very first thing they're going to go look at is what was your maximum drawdown to achieve that return? Okay, so our risk to reward ratio is a maximum loss of 1% after delivering a return of 15%. And there's no equity investor that has that kind of risk to reward ratio, period. And we can just look at the S&P 500. Most likely your equity portfolio has had far more volatility than the S&P 500. Let's face it, you've probably had less return than the S&P 500, and you've probably had more volatility. So this is painting a pretty picture of what you might have experienced of being a bag holder of equities. Okay, so what have you had to live through? Okay, 18% drawdown from November into December 2018. What did we get? 1%. Why the TLT? Our put options kicked in, reduced loss on the SPY, and the TLT flew up. Now, did we outperform the market in January, February? Absolutely not. Not going to happen. March and April, did we outperform the market? Absolutely not. Did we get better return than 1%? Sure. What was happening? The TLT were both going up together. It was easy trading. A monkey could have made money during that period of time. What happened in May? And yes, James, that's correct. What happened in May? Well, who would have guessed we're going to have a sell-off? And this wasn't even trade war related. This is after the Fed was becoming dovish. This was just plain old profit taking and rebalancing portfolios. Market fell 7%. Who would have known where the bottom is? I'm sure you didn't. I bet you're a little bit nervous though. Once again, the put option on our SPY kicked in, reduced losses, TLT flew up, saved the day. And we'll be looking at the relationship of the SPY to the TLT, and you'll see how well they work together. All right, July, I have my only loss. It was Dean's wedding, trying to work from Hawaii. I was playing it safe. I didn't want to risk us having a huge sell-off in stocks because I didn't know if the trade deal would work. So we were positioned pretty defensively, and that was our only loss. I'm also having to trade at 4 a.m. in Hawaii while we're out on sailboats having fun. So that's our only loss in 12 months. And I wouldn't take it back. Still looking back, there's no reason to believe we would have a trade deal after 2 years of this same crap happening over and over again. August, he came out with the tariff threat. Well, we were not positioned like we were in July for it, but without even seeing it coming, the TLT paid off. We had an 8.8% return. Last several months, I've been very cautious. I don't know what's going to happen. Are we going to have a trade deal or are we not going to have a trade deal? So we've had some okay returns. We didn't lose money, but the market's really gone nowhere. And so you can see our simple 4 ETF portfolio is extremely diversified. And it's all you're going to need for retirement. And we're going to look at the cycles that are going to come in the next 10, 20 years, how these markets are going to pop, and why you still only need these 4 ETFs. You don't need anything else. And again, our goal is to generate income and safety, not growth or speculation. We don't want to guess if something good's going to happen and put all our eggs in one basket. So if you're hoping a trade deal will happen and keep your stocks going up higher, that's really speculation. That's not a real strategy. Our goal is to help you simplify your holdings, reduce your risk, get better results with less work, and to weather-proof your retirement portfolio. Okay, so now we're getting into the meat of our presentation. This is actually part of a $10,000 boot camp, the first module of a 16-module course. So not a sales pitch. You're going to learn the real strategy for how we've simplified how to look at this and be able to predict the big moves. Okay, so in this day and age, there's one big person who really affects the markets, and it's a central bank, more so than ever in history. And so the first thing we really want to know is whether the Fed is buying or selling assets, primarily treasuries at this point in time. 2008 crisis, it was a lot of mortgage-backed securities. Now it's the bond bubble that they're protecting. Okay, so we know the answer to this. They're not just buying up assets, they're buying up assets at a faster pace than they ever have done in history. Next thing we want to know is whether the Fed is raising or lowering interest rates. Well, they're lowering rates. They've lowered it 3 times this year. And in fact, every time they've ever done that, we've had a recession. In fact, as much crap as they talk about the Fed not being able to stop recessions, you can look at this chart. What happens every single time they're lowering the rates? There's a recession. Now, do you think lowering rates causes recession? No. The Fed's very smart. These are some of the smartest bankers and economists out there. And so they're very good at predicting problems before they happen. They're just not going to tell you about it because it'd make it happen faster and worse. So they're very concerned a recession is looming. That's why they're lowering interest rates and printing money. Now, a lot of people I talk to, they've done very well over the last 40 years. They've bought and held through 3 crashes: the 90s, the 2000s, and the most recent housing bubble. And in all cases, they were able to hold through the crash and come out by being patient ahead of the game. But what I want to point out is that this time is nothing like the last 3 crashes. And what I really want to point out is that the federal funds rate went from 20% in the 80s, which you got to ask yourself, why on earth was it so high? And they've been able to drop those interest rates for the last 3 decades. Now, the problem is now they can't raise the rates. They tried to do that last year. What happened? They raised it a mere couple basis points, and we had 98% of all assets around the globe in the year at a loss. The only thing that went up were inverse products. So the Fed really can't raise rates. The markets become hypersensitive to any kind of rate hike. The banks are out of money. We have repo madness. They're back to lowering rates, printing money. But the problem is there's a lower bound. And in fact, if you read the latest FOMC minutes, which we're going to be detailing in our boot camp this Monday, it's about a 12-page document where they really lay out what's going to happen as we get to the effective lower bound. So without question, the Fed is going to slowly as possible lower rates to 0 and buy up government debt to support this bubble as long as they can. But the big question is, what happens when they get to the effective lower bound? And what is that lower bound? Well, we know they like to go to 0, but now we're starting to see the Eurozone and Japan go to below 0. In fact, there's $16 trillion of negative yielding sovereign debt out there. And so the bottom line is that probably what's in our future is the exact opposite of what we've seen for the last 40 years. So if you look at the period from 1955 through 1980, that's most likely where we're really headed. And so we'll talk about what forced the Fed to do such dramatic measures to get to a 20% interest rate with Paul Volcker. Now, did he want to do that? No. But really, the third thing we got to pay attention to is inflation. Now, the bad news is inflation's already here, and they should already be spiking rates right now. But they have manipulated the formula to really cut out housing costs, medical costs, college costs. And so all they're really looking at are your average day products like milk and Coke and really silly things like that. And so they'll sit there and tell you we have low inflation. Well, guess what? Because our interest rates are so low, corporations are borrowing at next to nothing. In some cases, companies like Microsoft are actually getting debt at negative rates. So Microsoft's getting paid to borrow money in foreign markets right now. And so this is a big picture. Think Netflix, think of Uber. There's so many companies that are creating products and selling them at a loss to take over market share. And they're only able to do this because the Fed has rates so low that the banks can borrow for nothing, the corporations can borrow for nothing. They can produce products at a loss, buy back their own shares. It's complete madness. That's the world we're in right now. But we're getting towards the end of the rope. Once this gets to 0, it's very questionable how long they can maintain that. Also, if you think about people who borrow money, if you have to borrow money at a rate of 5%, 10%, you're going to make smart investment decisions and you're not going to go lose that money. But if you can borrow money at 0%, you're going to be much more reckless. So it's very unhealthy to have rates this low. And that's why we're in such a very dangerous bubble right now. And most people have no clue what's coming. But eventually, when money does get out of these asset classes, whenever the Fed decides to hike rates, that's when the party ends. Yeah, and James has another thing. They also don't want the CPI index to go up because then they'd have to adjust Social Security, pension payouts, all kinds of stuff, which is another nightmare for America. So we'll be looking through the last 100 years, where we had good data, at when price controls got out of whack and what the Fed did to react to that and what effect that had on the economy. Bottom line is you get market crashes when that happens. But before we do that, let's take a look at these different assets and how uncorrelated they are. That's really what's important here. So we have the SPY against the TLT. All I really want you to observe from this is the orange line spikes higher every time this S&P 500 crashes. So in both these crashes, you're able to almost have all losses protected by the appreciation of the TLT. So we can see in this little spike, that's a 50% gain. In this little crash, we have another spike up. In this little crash, we have another spike up. In this crash, we have another spike up. So as long as the Fed can keep lowering interest rates and keep the bond market rallying higher and higher, this strategy works very well. You can just blindly own half TLT, half SPY, and have a very safe portfolio that works. But this does break once you get to the effective lower bound. Here's another look at the TLT zoomed in. Again, it doesn't do a whole lot until trouble works its way into equity markets, and then it spikes higher. So that's the core strategy here. Okay, now we're at a more zoomed in, and you can see at a closer detail, stocks go down, bonds go up. Stocks go down, bonds go up. Bonds go down, stocks go up. Okay, here's a massive bull market. You didn't really lose much on the TLT. You lost 2% after a 3-year stretch, as much as 20%. Stocks went up 50%. So it diluted your return by about half, but you had this huge amount of protection in your portfolio. And once again, you can continue to see this very healthy relationship of owning the stock market with the bond market at the same time. Okay, so what about gold? How does that fit into the portfolio? Well, what I want to point out here is that gold does not like to stay still. Hector says, so yeah, I do want to point out that in almost all these cases, they are traveling higher together, just at different time periods. So you can see, in general, during both these periods, they've both appreciated significantly. But the catch is that won't last much longer because we're getting to the bottom. Once you get to the effective lower bound, unless you think America's headed to negative rates, bond prices hit a ceiling. So we'll talk about what breaks this strategy. But what's important is we use the option callers to adjust. Okay, so what's important about gold? How does it fit into the portfolio? Again, I'm happy to play gold in both directions. And we'll be looking at how the bubbles pop in a minute. But I just want to point out that, look, gold does not stay still. And for us, that's very good if we can predict which direction it's going to go, because change of price is how you generate profit. And so the basic bottom line is there's 3 ingredients to be long gold. If you don't have those 3 ingredients, most likely it's going to sell off. So number 1, are rates headed lower? Check mark yes right now. That's not always the case. Is there quantitative easing? Is the Fed buying treasuries? Check mark yes, actually at a faster pace than ever in history. Okay, 3rd ingredient. So with those 2, we get a hold. We might have little drawdown, but we're not going to have crashing gold prices. The third ingredient is panic. Second you get panic, that's when gold really shoots. My expectation is there's going to be panic leading into the 2020 election over number one, this impeachment, and number two, over the trade deal potentially breaking down, which I think the Chinese actually want, as it would help them potentially get Trump out of office and put someone like Michael Bloomberg in office who's very pro-China. And also gold, although it does tend to follow along with the bond market, it does break paths. So it adds another layer of uncorrelated risk to our portfolio. Now, when you're at the very beginning and you're predicting that this will happen, it makes sense to own gold, just real gold, spot gold. After it's already in effect, it makes a lot more sense to buy the gold miners because they can benefit from the elevated price. So that's why we own the gold miners and not spot gold at this point in time. Most of the year we're on GLD and not GDX. Okay, so let's take a quick look at these assets and then we'll jump into what I see happening into the future. Okay, first of all, what's the SPY? It's a $262 billion fund. It's bigger than Ray Dalio's fund. It's almost twice the size of it now. Ray Dalio has the biggest fund in the world in terms of private equities. It has 504 companies. It's overweight in technology and financials. And biggest company is Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway, Google, and JP Morgan. Emerging markets. This is a 1,000 basket ETF. All the big banks are trying to push everybody into this Chinese-based ETF. China's huge. They're on track to become a bigger GDP than the US in the next decade. Maybe these actions by the administration will slow them down considerably. There's good and bad that I can point out in China. From our standpoint, I'm happy to profit in either direction on emerging markets. It's highly liquid. It's the most traded ETF after the SPY and the QQQ. So it has lots of liquidity and a very healthy option market. This allows us to safely profit in either direction as long as we can get the direction correct. Has $25 billion in assets, so it's about 1/10 the size of the SPY. And it reaches Hong Kong, which is basically just China, South Korea, Taiwan, India, Brazil, South Africa, Russia, Thailand, and Saudi Arabia. Note, it does leave out Japan. The main companies that are really important are Alibaba and Tencent. These are two huge, gigantic companies that are supported by the Chinese government, and they're in the top 10 most profitable companies in the world, at least according to their financials. You're not allowed to audit any Chinese company. That's part of their law. And so Chinese are innovating very fast. They've replaced Facebook with WeChat and Tatua. They've replaced Amazon with Alibaba. They've replaced Starbucks with Luckin Coffee. They have a company called TikTok that's gone global with over 1 billion users, putting pressure on Facebook, who dominates the app space. And they work really hard. In fact, they work 9-hour shifts, 6 days of the week, and they get taxed at 70%. So they work really hard to take home 30% of their pay. Government takes all that, uses it to subsidize industries and help keep this whole huge population busy. Are they building things that are useful? Probably not. They have 25 cities the size of New York that are empty. They have 55 billion houses they've built that are just concrete shells that are collapsing. They don't allow the free market to pick prices of real estate. You have to get approval from your little local government. Yeah, it's a big joke. So they have certainly misallocated more capital. They've laid more cement in the last 10 years than America has in the past century. It's absolutely insane. But they've planted a seed. With all this misallocation of capital, they've managed to steal technology from all around the world and bring 700 million people out of poverty. They've grown at rapid pace. So it'll be interesting to see how this trade war ends up. It's not going to be done in a month or 3 months. This is probably the rest of my lifetime. We'll see these two powers fighting over control. And they're starting to take the lead in 5G, AI, robotics. The list goes on. Facial recognition, social credit systems, space exploration. So there's reasons to be invested in emerging markets. Okay, GDX, most of the mining is happening in Canada. The big companies that you want to be owning are Newmont Gold and Barrick Gold. Really, all the others are much smaller positions. And I found a lot of people go buy these tiny companies. One YouTuber I like to listen to is all about this sandstorm gold for some reason. But look, most money is just buying GDX. GDX turns around and distributes the capital into these equities. Well, my company that I like, Newmont, gets 10% of all the capital flowing through. This guy gets 0.5. So if you own a big position in a little mining company, most likely that mining company is just going to take your cash and run investor relation ads to raise more capital. They're not going to mine any gold. They're not going to have a profit. It's really just these two companies that are supported by huge hedge funds like Stanley Druckenmiller's all in on the gold, GOLD, and BlackRock, the biggest asset manager holding trillions of dollars, they own most of Newmont. So those two companies can actually get the loans, get the mines going, pull the gold out, sell it to the central banks before this all collapses. Most of these mining companies have huge losses, so it's not a smart idea to go try to handpick mining companies. You're much better off with GDX. Okay, and just a quick shout out, if you do decide you want to join our program, we're throwing out a free bonus today where you get 1 month in our $10,000 boot camp absolutely free when you do join the advisory. So call Dean to reserve your spot and make sure you save his phone number on your phone. We're not done with the presentation. I just want to throw that out before we get into the really juicy stuff. Okay, so at this point, I'm going to go into my forecast, which is going about 2 decades into the future. We're going to talk about really the inevitable collapse of these bubbles, and then I'll open this up for Q&A. Okay, so when does the long bond stock strategy break down? And how do I see this playing out? So first, we got to take a little look at history, and then we can come to the current and try to predict the future. So the big problem is when the Fed raises interest rates and stops quantitative easing. And they usually do that because they lose control of prices. And either prices inflate or deflate, and it causes major problems. And so we can look at the Dow over the last 100 years, and we can see some pretty bad times to own equities. So we can see World War I, a huge crash. World War II after, or leading into World War II, a much worse crash in 1930. So we had the 1920s, everything was grand. And then we had almost a 90% crash. The Dow went from 5,000 down to close to zero. Then we had a great period of time until we didn't, until we got to 1965. And all of a sudden we have a 15-year bear market. What caused that? Well, you're going to see it was runaway inflation caused by FDR and a whole bunch of guys creating massive stimulus to the economy. Credit systems, social credit systems. So what's this CPI and this inflation all about? Well, they change it. That's the problem. If we go back to 1990 or 1980s metric, which I'll show you, we already got so much inflation, it's incredible. They should be raising rates right now, but they're not. So right now we're in this band where inflation's headed lower, and it's causing the Fed to keep lowering rates to try to spur inflation. They're actually trying to get inflation, but they can't, at least with the way they measure it. But every time they do get inflation, the world has periods of financial crisis. And so the blue line is when inflation spikes. And it tends to just come out of nowhere and spike rapidly, as we're going to see in a moment. Now, what does the Fed do when the inflation does spike? The same thing every time. They look at the inflation rate and they spike the federal fund rate, the red line, above the inflation. It's very simple. That's their formula for stopping inflation. And so during the 1960s through the 1980s is when we had the last big round of inflation. So Paul Volcker was the chairman during that entire period, and he would raise rates, thought the inflation was gone because it would die down, and then he would lower rates back down, and it came roaring right back. And then he would raise rates, and then it would die down, and then he would come back. Every single time he rose the rates, you have this gray bar, and you have a big recession, like clockwork. Now, in the last 40 years that most of you guys have been investors, you've had the exact opposite. You had the benefit of coming from extreme high rates of interest, where no one's going to borrow unless they have a hell of a business plan. Think about it, 20%. And you've had the easy period of life where for the last 4 decades, they could just lower rates and keep this bubble going. So we're not in an 11-year business cycle, really in a 40-year business cycle. Now, what happens when they raise interest rates? Well, you get your rare negative GDP print. So it's no wonder that you get stock crashes when they raise interest rates. Lending stops, debt stops, growth stops. Does it get the bad investment out of the economy? Yeah. Does it make people go bankrupt? Yeah. Think about the old Warren Buffett. You don't know who's swimming naked until the tide rolls in. Well, that's what happens when they raise interest rates. We see who's swimming naked and they go bankrupt, or at least they should. Unfortunately, in the last 2 decades, instead of letting banks who should have gone bankrupt go under, we've bailed them out. Should be criminal. But that's way beyond our goal of this program. We just want to predict what they're going to do. And so the effective federal funds rate is something of a magnet to treasuries. And so if we can predict what direction the Fed must travel with the Fed's fund rates, we can predict the outcome of the bond market. Now, the bad news is, the good news is that we know they must push to zero because of the tremendous debt we have to serve, and that we're growing our debt and our deficit at a faster pace than we're growing our GDP. So the big weight right now is to push the rates back towards zero. So that will push the TLT higher. But what happens when we get to that effective lower bound? That's what everyone's really concerned about. Is everyone going to bail right before we get there? So now the Fed's trying to tell everyone what they'll do when they get to this effective lower bound. And so on Monday in our boot camp, we're going to spend the entire 2 hours just going through their Fed's minutes and dissect it page by page. So you'll see exactly what they plan. And it's quite crazy what they're planning. More of a socialist system than a free economy. That is absolutely frightening what they plan to do. Bottom line is this could be very bullish for gold once we get towards that lower bound. So, okay, so we know that if we can predict the Fed, that really is the key to all of this. Next, let's just take a look at inflation. And let's also take a look at what happens when the government subsidizes an industry. So the industries they don't subsidize have very little inflation, but magically the ones they do subsidize have tremendous inflation. So in this example, you can see medical costs have skyrocketed. Housing costs have skyrocketed, both very manipulated by the government. And what about college? Wow, the second the banks got a deal from the government where you can't bankrupt college loans, and they'll essentially guarantee it. Well, colleges quickly rose their prices, and the banks quickly started lending to anyone, no matter what. They don't care whether they could pay the loan or not. So what do you get? Skyrocketing college, skyrocketing medical care, skyrocketing housing. And so even though it sounds like just 2% a year, if interest rates start going, okay, so James has a question. If interest rates start going up, many recent T-billers will be, right, James. So that's the big, so everybody knows that. The Fed knows that. If they let rates go up, trillions of dollars of people who hold treasuries are going to be underwater. They're going to be having a treasury that yields less than inflation. There's no reason to hold that. The only reason people are buying treasuries is because they all understand what must happen. Either the government is not funded or the Fed must lower rates. It's just that simple, because everybody will sell their bonds and rush for the exit. All right, so let's look at the scary thing. They should already be raising rates. If we look at the 1990 CPI, we're sitting at a healthy 5% inflation, and we should be having rates around 6%. The 200-year average cost of money has been 5%. We're well below that. So the risk of us overshooting inflation and being forced to jack rates up like Paul Volcker did is very high. Okay, now, if we go back another decade, it's even scarier. Not in this trend, at least it's flat. It's just a steady high level of inflation. In this chart, you can see it is in an uptrend at 10% inflation. So in an uptrend, they should be overshooting rates to something like 15%. Very scary. Now, stock market keeps going up on good news about unemployment at record lows. But what happens when there's no more people to hire? They're going to demand higher wages. And if you listen to the meetings between businesses and the Fed, all they can do is bitch and moan that they cannot find cheap labor. That's all they talk about. That's all these companies are concerned about. They cannot find cheap labor. So we have inflation coming. Just a matter of when will the Fed react. All right, so now we're going to go through last century, look at when inflation did perk its little evil head up, how the Fed reacted, and what did the stock market do. Okay, so this is going way back. We're still on the gold standard. World War I is happening. This is where we got all the gold from all of the world. Everybody else went bankrupt. Germany loses World War I, but wreaked havoc. Everybody wanted reparations. And eventually, Germany just couldn't pay all these demands. They did all sorts of crazy things. They invented new currencies. They printed tons of money. They ended up with hyperinflation and caused the Great Depression. So that's kind of what may happen to China right now. Everybody's pissed off that they've been, China's not out trying to roll tanks over everybody's backyard, but they certainly have been stealing everything and trying to subsidize industries, put us out of business. Think about Huawei. They've become the #1 seller of phones in the world in terms of just total number of phones sold, but they're selling phones at a loss. They're subsidizing with the tax receipts of 700 million working people who they tax at 70% and allowing themselves to sell phones at a big loss. That's not fair now, is it? Meanwhile, they're stealing technology. They're buying out companies, bringing it over to China. The list goes on and on. The world's most likely going to overreact to this, punish China. And they're such a big economy, they can take everyone else down with it. So that's why Ray Dalio likes to relate this time period to where we're at right now. But what we can look at is inflation and deflation. So this is back when we're on a gold standard. The previous century before this is really highlighted with currency wars. We had countries, it was a very easy strategy. Go to your neighboring country, deposit as much money as you can into it with all your friends, and then let them go lend all the money out, and then go try to withdraw it all at one time and convert it into gold. The second the bank thought it was out of gold, they would close shop and you get a bank run. And so it's my knowledge of the previous century is much less, but it's just story after story, currency war after currency war. So eventually we got rid of the gold standard because it was such a easy way to really hurt another economy. Just pile a bunch of money in, let them loan it out, and then go try to withdraw it all at once and create a bank run. Okay, so we got the Great Depression, we had inflation, deflation. What happened to stocks? Well, let's look. From 1921 through 1930, you can see pretty stable prices. Prices are under control. There's not really a whole lot of inflation or deflation. It's the roaring 20s. And stock market flew up from 1,000 to 5,000. But alas, it was a big bubble. And we get the Great Depression. It crashed something like 95%. Just one of the worst US stock crash of all time. Now, they didn't have the Fed back then to print money and devalue the currency, but pretty quickly they'd figure that one out. Okay, the next big period of time is the Cold War. So we get out of World War II. We're doing all sorts of things to get the GDP going. We're giving out money left and right. We're trying to compete with Russia on a national world stage. And for much of this period of time, there's low inflation. We can see from 1945 through really 1966, very low inflation. Prices under control. There's no deflation. There's no major inflation. We have one little problem, 47, 48. Other than that, prices are pretty stable. Stock market loved it. We went from a 2,000 Dow to an 8,000 Dow. But what on earth happened? For the next 15 years, we're pretty much in a bear market. Now, sure, it goes up and then it crashes, and it goes up and it crashes. It goes up, it crashes. Can you guess what was happening? What do you think the Fed was doing with interest rates during this period? You think they were maybe lowering them when the stock market went up and then spiking them when it crashed? You got it. So it was actually a little bit of the opposite, but they rose interest rates when they thought they had inflation under control, or when inflation was not under control. And eventually it caused stock crash. So we can see what Paul Volcker did. He raised interest rates, stock crash, lowered interest rates. Inflation came perking back up, rose interest rates. Let's go back to the inflation period. So we can see they could not get inflation under control. For the better part of 15 years, inflation continued to go higher and higher and higher, all the way to prints of 13% in 1980, which is why he went up to a 20% interest rate. So during this entire period of time, the gradual rise was interest rates went from 2% to 20%. Eventually, they got all the malinvestment out of the economy. People aren't borrowing money who don't have a real business. And we enter the period that we currently have been in, a 40-year bull market from 1980 to current. It's really just been one big bull market cycle. And so what did inflation do during this period? It was under control. It was lowering. This is your Alan Greenspan period. And the stock market went from 2,000 to 18,000 in the Dow. Now, were there some little hiccups along the way? Sure, but nothing to be concerned about. And that's because the Fed had ammunition. They were able to lower interest rate, make the cost of money cheaper, and this worked for a long time. And now we've created a lot of debt. Namely, in the last 2 decades, we've really grown debt at record pace. And the result has been that the market's become hypersensitive to any spike in inflation. In the past, we could probably deal with 5-7% inflation and not a big deal. But now we get up to 3.4 or 3.8, and you get a financial crisis twice. But they still had some room at this period. In the dot-com bubble, we had the ability to drop rates from 6.5% down to 1%. And that's about what it's taken in general to get out of a recession, a 5% cut. So they did that in the dot-com bubble. They're able to do that housing bubble. But then they went to the zero bound where money's free and more misallocation of capital has transpired in the last decade than ever before in history. And now this time around, they can't drop rates 5%. They can't even drop them 2%. And so here's where we're at now. Low inflation, everything's grand, and we have one hell of a bubble. So what are they going to do next? We'll see. They know they can't cut it 5%, so that's why they're doing QE and rate cutting at the same time. Usually they cut rates, let the stock market crash, and then do QE. Not this time. We're going to blow this bubble beyond proportion. So on Monday, we'll look at what they're saying they're planning to do when they hit the effective lower bound, because that will freak everyone out. They know they can't keep the bubble going once you get to zero. Or can you? So we'll see what they really do. But the latest Fed meetings are very scary. To summarize, what they are saying they'll do is, number one, they're going to put up everlasting repo market. So you can get free or relatively cheap credit at any time from the Fed, open doors. Two, they're talking about putting a maximum yield on bonds. So there's no free market in the bonds. This will distort the market severely, but maybe it'll convince people to buy and hold these bonds and not run for the exit. Maybe, maybe not. And then three, they're starting to look at Europe and Japan and say that negative rates are a good thing. So if we see those rates go into more negative territory, primarily German bond, maybe we'll go below zero. So that's what we have coming for us. And so how does this play out in the markets? Let's take a look. All right, so I have really two, let me take a quick break. Do we have any questions so far about the presentations? Because now we're going to go into what I think may happen in the future. And I really have two outcomes. And Dean, do you want to say anything at this point?
Jason, I just want to say great job, man. That was really, really good. You're just constantly adding more and more information and background behind the context of why we trade this. I just really appreciate it.
Oh, thanks. Yeah. Well, we've done the presentation a few times now, so I'm getting it really honed in here. Simplifying it.
Right.
All right, let's talk about how we pop these bubbles and get rich from it, okay? So we got two outcomes. One is without pressure, one's with pressure. All right, now if I had to gamble, I'd say that this outcome is less than 50% odds. Okay, this is how the bubble will pop if we don't pressure China or end up with Elizabeth Warren as president, okay? Low rates, low inflation, quantitative easing, no trade war. Okay, in this position, we're just longed everything. We're in a nice, healthy bubble. What could go wrong? Well, eventually, as your insiders keep selling stocks, and we got two real types of insiders. We have, your Mark Zuckerberg, we got your Jeff Bezos, who are, they're literally selling their shares as their corporation does a stock buyback. So they're borrowing money from the bank, who's borrowing money from the Fed to get their money out of the market because they know their company's not really worth $1 trillion. Okay, so but how much can they really sell and put into cash? That's really what all these big CEOs, this 1% of the uber rich billionaires are trying to do. They know they're not really worth $1 trillion, but how much can they get away with selling? As they sell and start buying stuff, money finally makes it into the system. On the other side of the coin, this environment's allowing the government to create more and more debt, which it is flowing a lot to the bottom up. And as this continues, we also see unemployment get lower and lower. We're seeing people demand higher wages. So there's inflationary pressures. Eventually, inflation comes. So that pops your bond market. So you can see in this, I've got a negative on the TLT. So if everything just continues hunky-dory, there's no panic, eventually inflation will scare the bond market, okay? I think this could potentially go on another 2 years. And this is also based on us getting near that zero bound on the federal funds rate. If they are able to magically slow this down to cut rates every 3 to 4 months, it gives them about 2 years of time until we get to the effective lower bound. And then there's no reason to own a bond when it pays 0% a year and you don't think they're going to go to negative territory. So there'd be no reason to buy the TLT. So in this environment, stocks and even gold can go up because we're just in a massive bubble and eventually inflation comes in. Okay. Eventually, bond market sells off enough to become attractive, to actually buy bonds for what they're supposed to do. They're supposed to give you income. So if the yield on the bond gets too attractive, all you got to do is go back to 2018 October. What was the 10-year treasury priced at? It went to 3%. Okay, if inflation's 2% and a 10-year yield is giving you 3, your banks are going to ditch these stocks that are at all-time highs, cash out, and they're going to leverage in as much money as they possibly can into that TLT, into that 10, 20, 30-year treasury. It's a guaranteed profit. They can't lose. So eventually the bond market yield can become so attractive that will give you your tug of war. So now we get sell off in the SPY. Now in both of these instances, a whole lot of money has come out of both markets into the real economy, not into these inflated assets, into the real economy. Okay, so what happens next? Well, you get the money out of the bubbles and into the real economy. I guarantee you, you get your inflation. Finally, and you're going to see both of my outcomes end with the same conclusion. Eventually, the Fed must raise interest rates and get all the misallocation of capital out of the economy and get prices under control. Because when money is free, it distorts the markets. So when we have rising rates, not during a good time, you know, the Fed likes to raise rates when there's good times ahead so they can try to prevent the next crisis. But what I see happening is we're trapped. They can't raise rates. They've tried to. Just look at 2018. Everything was great. Make America great again, blah, blah, blah. They try to raise rates, we got a stock crash. So we're going to end up in a period where things aren't great. We've just had the stock market and bond market have a mini crash. And now the Fed has inflation. So they're going to have to raise rates and actually give us the medicine we need to fix the economy. This is a period where you want to short everything under the sun. The SPY, the emerging markets, the TLT, and GDX. Okay. Then you get back to something like the 1980s. Rates are extremely high. The anticipation is that now inflation's done. We've had lots of bankruptcies. Both bubbles have popped. Not one, but both. We have a period of rates going lower, and we have expected QE in the future. That's what you had from the 1980s through current. That's what we might have maybe in a decade from now. If you listen to Ray Dalio, Stanley Druckenmiller, maybe it's a decade and a half, 2 decades away. It's going to take some time. But that's where we get rid of gold, finally, and just buy us some shares of Apple, Warren Buffett's biggest position. And once again, you can be long all of your assets. Easy trading. Okay, so how does the bubble pop with impeachment becoming more and more pressure on the political side? And you got to believe it is tied to this China. Really, what do the politicians not like? I would argue it's the foreign policy. And certainly China does not like our foreign policy right now. So most likely outcome in the next 12 months is trade war escalates and China tries to get Trump out. And that presents 2 risks. Number one, can Bloomberg really, despite Bloomberg being definitely pro-China, if you listen to him, the guy wants to fix the budget. He wants to rip the Band-Aid off. He'd probably like to raise rates. He'd like to actually fix the economy and be prudent. Is anybody going to vote for that? That sounds more like a Republican pitch, not a Democratic pitch. So we do have a big risk of someone like Elizabeth Warren, who's out here saying, look, I'm going to take 2% from the billionaires per year. And guess what I'm going to do for you? I'm going to give you free childcare. I'm going to give you free medical. I'm going to give you free everything. You know, so there's some big risks really right in front of us. And China knows that. You know, in fact, I bet China would rather have Elizabeth Warren at the seat than Michael Bloomberg or Joe Biden, because they want to take the lead in the world and become the dominant power. So if you think we got easy times ahead for the next 12 months, good luck. All right, let's look what happens. So we got some risk in the market. We have some fear. We're still in a period of lower rates, low inflation. What happens if we get fear? Well, let's say Trump realizes that if he escalates the trade war, the Fed might lower rates, which he seems to want. So, okay, he escalates. We're going to speed up the timeline a little bit here. We're going to get to the effective lower bound much quicker. We're already headed that way just because of the spending of the government being greater than the tax receipts. The bond market and the Fed are already trapped in that path. There's really no way to get out of it. Now you listen to Larry Kudlow talk about their plan to fix this. Well, he says, well, our strategy is to get GDP above 3%. So yeah, if we could get GDP above 3% and grow our debt at less than 3%, maybe we can have a Hail Mary save. But right now, we're spending about $1.50 of debt to create $1 of growth. So we're in the opposite trend. And meanwhile, over in China, they're spending $7 to get a freaking dollar of growth. So unless we want to raise rates, get all the misallocation of capital out of these economies, let companies go bankrupt and really restart, interest rates are going to zero. This will just speed it up. So we've seen what happens every time we get trade war escalation. It's a short-term sell-off. It's not a long-term sell-off, okay? Because what's going to happen is rates get cheaper. Corporations can borrow for less. They're going to keep buying back their own stocks so they can get the hell out of Dodge. These CEOs want to cash out as much as they can while prices are at all-time highs. So in this environment, I would be willing to play the momentum for a short period of time. 2-3 months, most likely at most. Now, figuring out where these technical levels are to get back long, that's another discussion that we do in our paid advisory, but we have some good experts to follow for trying to look at technical levels. But the big picture is we get trade war escalation, short it for a short period of time, buy the dip. And that's what we're kind of expecting right now. That's exactly what I'm expecting right now. That's why I'm paying a premium on the puts and expecting either stocks fly higher on a trade deal or bonds fly higher on no trade deal. So we get the stock markets selling off, bond markets pushing higher. Okay, but once again, all of a sudden we have rising inflation, we have massive QE, and we're at the effective lower bound. This will freak your bond market out, and now equities are considerably cheaper, and there's free money. So corporations will be more than happy to buy their stock and see what happens, and also sell their insider shares. So in this case, we get the TLT selling off. Stocks and gold are now benefiting, and now we're near 0% rate. Bonds sell off enough, yields get attractive. Well, we saw this happen in 2018. When the yields get too attractive and they get above the expected inflation, banks will jump on that for a guaranteed profit. They'll sell their stocks and they'll jump into bonds. And now we're at the zero bound. We've gotten money out of these bubbles. We've done massive QE to fight this trade war. The rates can't go any lower. everybody knows there's no choice. We have to raise rates. We have rising inflation. You end up in the same predicament where you have to be short everything. How long will this last? Who knows? Could be a decade. And then you get back to the reset. Good times. We have very high rates that can be slowly lowered for decades to come. Expectation of QE. And that's when we're back to our Buffett strategy. Buy some Apple. And we can be long bonds and stocks. All right, guys, I'm going to go ahead and unmute everybody and see if we have any questions. Now I have a little bit more to show you after this, but primarily that'll just be what I do every day for you guys. Okay, I've unmuted everybody. I'd love to hear some questions and comments. How about we start with Jeffrey? He's been pretty vocal for this presentation so far. What do you think, Jeff?
I'm good. I think I think you explained everything pretty well. I understand it. I think you understand it probably more than anyone I talk to on a regular basis. But no, great presentation. Thank you.
Okay, great. Yulette, questions, comment?
I concur with the person just talking. Yeah, it was a great presentation. I mean, I understand, like, you know, getting the background as to why things move. I think that was great information.
Nice. Now let me ask you, both of you guys, real quick. Is your portfolio at risk to a stock crash? Or are you protected to the downside, or are you just in cash? Or
I'm just in cash.
you're just in cash? Well, hey, that's better than just feeling lucky, Clint Eastwood style, huh? What about you, Jeffrey?
Mainly cash.
Mainly cash. Okay. Don, what was your feedback so far?
It's really interesting, Jason. I just have some concerns about this. Basically, has to be in a retirement account. Otherwise, this is all short-term gains, isn't it?
Not necessarily. I mean, sure, you're going to pay taxes one way or another, but yeah. So the profits from the options are short-term gains, but as you can see, we're going to be buying and holding the underlying asset. We have a relatively low risk of being exercised, so we can still enjoy the lower tax rate as long as we can hold these for over a year.
Okay.
But yeah, I'd rather play it safe and adjust our strategy versus you know, just try to buy and hold and not worry about a 15-year bear market. I'd rather pay a 35% tax and hold on to equities for the next decade. Where we
Sure. I have a question. Like I mentioned that before in the private deal. What was, just for ballpark, what was the cost when you're buying those premiums of those puts when things were crashing? I mean, how do you get the offset to that collar to work for you that way?
Oh, so yeah, so the call options and put options are connected. So as the put option goes up in value, so does the call option.
But not, I mean, they're going to expect more for that skew to the downside when the thing's crashing. So you're going to be paying more for that put. I mean, a lot more for that put than you're going to get out of the call to cover that price of it.
So yeah, I mean, you can go look at, if you look at our track record, you can see we do very well when the stock market goes down for a number of reasons. And certainly when we think the market's going below, if we think the stock's going below, we're going to sell the in the money call and then buy the in the money put. So we can actually profit to the downside. Is great for us for a lot of reasons. Number one, obviously, in terms of selling this service, we really shine when the market goes flat or down because everybody else is losing money and we're making better returns than normal. So from that standpoint, we love that. But two, despite us being compared to everyone else, market moves faster to the downside. So there's a lot more profit to be generated. So we love when assets go down. And you can look, the track record speaks for itself. When the market goes down, we do better than normal.
So when you back tested this like in 08 or whenever that big crash was, how did you guys do then? Just on paper?
Well, just look at December. We had an 18% sell off and we returned 1%. But yeah, you know, I did have a screenshot of it. If you just had the TLT and the SPY, the TLT went up 40. That's like
If we're kept to the upside, but because we're selling a call, but to the downside, we can really do well because we own the put. Is that right, Jason?
Yeah, so we're going to make more money to the, you know, it's just the downside's a little ways off, guys. But we cannot wait to be putting on these inverted option collars because the put option, we're getting people to agree to buy our SPY share for $300. And in this example, the SPY is only worth $298. So we're buying an in-the-money put. That allows us to own the asset and still walk away with a profit if it travels lower because we're paying for the put with the call. So the call
Then your volatility will increase and then you'll get more money. I see. Thank you.
We actually make more money than this would indicate because there's some implied volatility and we're still having some time premium left. Now, the opposite's true on these ones. This is very accurate to what our maximum loss and return will be because we're not having a benefit from implied volatility increasing. But on the downside, you'll see we can actually make more than the chart would indicate. This is what you would have at expiration. But we're closing these out and rolling over the position with some time premium left.
So over this year, how many times have you guys got it assigned?
We only got assigned back in January when the market was just flying up.
Just flying, okay.
Yeah.
Okay.
Very, very rarely will you get assigned.
Mm-hmm.
And when you do, you got to realize that means you hit your max profit.
Right. Yep.
And so we're going to end up in cash. Now, a lot of people like to sit there and sell put options. Terrible idea. What happens? You wake up one day, the market crashed, you've overpaid for the asset, and you're going to be panicking to sell it for a huge loss. So in our strategy, we end up in cash if we're ever assigned. Whereas if you're a put option writer, that's really a game for big banks who have access to almost unlimited capital. You shouldn't be selling put options unless you're a bank. I mean, it's just as simple as that. Is there more track record since last November? No, there's not. So my background is that I was the marketing manager and business manager for every guy you can imagine under the sun who's been in this business. And so I got to see what they do, got to meet them, sold probably $50 million worth of their products, probably about 15 different gurus. They all had the same problems. Number one, they all thought they needed to outperform the indexes. Why else would they be there if they can't outperform the market, right? So that doesn't work for very long. You end up taking outside risks, you speculate. That's the only way you can beat the market, is guess what's going to happen in the future. So they end up losing money, bottom line. Two, their products, besides being risky, were hard to follow. People didn't know when the trade alerts would come out, and they didn't know how much capital to put into each trade. So it was confusing. People didn't get the same result. Three, they didn't know when the trade alerts would be released. So they're missing trades. They're not getting them at the same time. Our followers love this program because the trades come out at the same time every day. We all get the same results, you know, minus 30 minutes. I take the trade at 11:30 and get it to you by 12. And that's just how long it takes for us to produce this whole piece of content that comes to you that shows you exactly the breakdown and P&L of every single position. So now I have ran other services in the past myself that did very well, but in 10 years, what I've realized is people don't need to take more. If I had shown this product to myself a decade ago, I would have fallen on the ground and laughed. Who wants to make 1% a month? But in 10 years of doing this, I realized who cares what people want? What do they really need? And what you guys need is a smart way to protect your assets. And when it's dead easy, make money. But when it's not, be protected and don't lose. So I'm much more concerned about not losing you money than trying to hit 1% a month. If we hit 1, 2, 3% a month, that's because it was dead easy trading. We knew what was happening because of the big picture, and we're able to do it almost in a risk-free method. And you're right, Jeffrey, 1% a month is great. And mostly the people who buy this program have very large portfolios, and they get it. They get it. They've had enough heartache and stomach ache from volatility. They're done with it. And they're ready to play it safe and smart.
Jason, did the track record of your trades show any any cost of trade in the past? Commissions.
I've set the commissions at 0 on all trades.
Okay. All right. So now it should be more accurate to how we trade, whereas a couple months ago it would have cost more, I guess, because we're trading so much.
Yeah, a little bit for sure.
Yeah, and one of the offsets there too, folks, is the dividends that are involved. We don't quote the return from the dividend in our track record as well. So net over the entire year, you should end up with basically no commission costs.
Oh yeah, and if you like dividends, realize the SPY is pulling dividends from 500 companies. And so yeah, we don't even report the dividend revenue.
Yep.
But I should. I always forget. I should go add that in.
Yeah, it's 1% net after fees from their management fee that you'll experience. That we don't even put it into the track record. So.
And I believe the TLT is yielding over 2%.
Yep. Yeah, I think it's at 2.3 right now. So.
Yeah.
Although we know what direction that's headed, don't we? Let's see.
EM is also yielding too.
Yeah, what you're saying is that the yield's probably going to go down because the TLT is going to go up.
Right. So yeah, the bottom line is, as long as we have a government that wants to create deficits, the Fed's really trapped. They have to lower rates. And I could spend 3 hours just talking about that, but they're really trapped. Now, does that mean we won't have volatility? No. Certainly we have to be aware of volatility. But the big picture is that right now we have $500 billion a year in interest to service. That's a staggering figure. And at the current rate of increase in deficit, just from the CBO, they're projecting $2 trillion in a decade of interest payments. Where's all the money going to come from? And we're not balancing the budget, so Trump's plan is to blow out the budget and try to get growth above 3% and then start to try to cut out costs. But he's the biggest spender of all time. So as long as the debt is expanding at a faster rate than the tax receipts, unless you think the Fed's just going to basically fold up shop and not have a purpose, they have to cut rates and they have to support the bond market. And they are. So we can actually look at their actions. And when you read I definitely recommend everybody who wants to go look at their FOMC minutes that were released. It was Wednesday. I guess that just came out. I'm about halfway through. It's like 20 pages. They go into all of this in great detail, and they realize the predicament they're in terms of hitting that effective lower bound and what that's going to cause the bond market to do. So now they're talking about putting a cap on the highest yield, all kinds of very crazy things that at the end of the day, you don't want to own cash when the Fed is bailing out the banks and buying up government debt and monetizing it because the value of your dollar is going to depreciate. Even if we just take them at their own word of creating 2% inflation, what is that? It's about 30 years to get to zero. So yeah, you certainly don't want to be in all cash for a very long period of time. When you know your government's going to devalue your currency at record pace. And the pace in the last 2 months is the fastest we've ever seen in history. And they're calling it not QE. Oh, how funny. Yeah, I guess the Simpsons have predicted all kinds of crazy stuff. Let's see, we've got some other people I'd love to hear from. Let me just shout out some names, see if we get you to communicate with us. Oh, and I just unmuted another fellow, Harmonic Wealth. A lot of people want to try to not own the asset, but then you don't get the right to, yeah, our strategy doesn't work without owning the asset. So it's really that simple. Because, we need to be able to get assigned and then go back into the trade. And so if you buy a leap, you're taking a lot of risk. So no, I wouldn't do it with leap options.
Yep. Plus you lose out on the dividend too.
Yeah, so we're really taking advantage of 3 things. Number 1, we have the capital to own the assets. I guess 4 things. Number 1 is we have capital. That's our biggest advantage. Number 2, we're going to take advantage of the option market. We're going to sell call options and we're going to buy put options. So that's 2 advantages I'd say give you an edge. Number 3, we're going to have a uncorrelated basket of assets. None of these go up and down at the same time. Now, sometimes they do, but not normally. Over the long run, we can predict that each of these should travel higher because of the macro environment. Gold, stocks, and bonds should all travel higher as long as we're lowering rates, doing QE, and having 2 emerging powers go butt heads, which probably last for decades. So you uncorrelate your assets. That's the next big secret to reduce volatility and risk. And then 4, we're using the 3 types of option callers to enhance the returns even more. And now this is really where, you could probably take my presentation, just go buy those 4 assets and realize you got a pretty nice run ahead. But where the real expertise comes to really enhance returns is exactly where you put these callers. And so this is just really simplifying the 3. Right now we're doing something like this, but scoot that to the right. I'm putting the put option at the trading price. So yeah, there's a lot of finesse. Let me just give you guys a quick feeling for what I do every day and what I teach in our boot camp, which again is a bonus that we give you for the first month if you join today. Okay, so first of all, I recommend Ameritrade phone app. It's beautiful. It's so easy. We've got millionaires who are taking these trades in the airport, in the restaurant, you name it. It's hilarious. They don't want to be bothered with the 1-hour video I put out every day with all the news, that's super valuable. No, they get it. They don't care. They really just want to do the 2-minute trade. They get it. They want the results. That's it. Okay, so we're going to show you how to do the trades on your phone. It takes 2 minutes to get the text message. Super simple. And now Ameritrade has free commissions, and I guess they're going to get bought out by Schwab. $6 trillion in assets. Pretty crazy. Okay, the next thing I'm going to do is show you all the YouTube channels I listen to. Jeffrey Gundlach had a funny webcast not too long ago. He called it YouTube University. How right was he? There's so much free information. Now, every Saturday, I send out 5 videos to my members of what they should study. These are usually around 30 to 60 minutes each. And it highlights what I've consumed in that previous week. I'm watching, at a minimum, a bare minimum of 5 hours of YouTube content a day and listening, not watching, from many sources. Okay, so I've got your Chinese media, I've got Russian media, I've got your hardcore conservative, I've got your hardcore liberal, I've got your moderate, I've got people like the Center for Strategic International Studies who go do war tanks trying to predict what's going to happen in the China war. Okay, so I've got a whole bunch of YouTube channels. I'm going to plug you into exactly those and show you how you can create watch lists at all. So I'll go throughout the day and collect all the best videos, and then I'll go reorganize it and plug and play. Go listen to this. And we're also going to actually start giving you access to a Telegram group chat so you can see all the videos every day as they come in. Because I was giving them a daily homework assignment. It was about 3 to 4 hours of daily content, and that was too much. So here's some of the channels I listen to. Also, I'll go look at history channels to try to study like the Cold War, World War I, World War II. And so that's probably where I'm strongest in terms of history, but I need to go back several more centuries, like Ray Dalio has, to really get a better grasp. So I'm constantly trying to learn. And so if you want to not just get the trades, but you want to learn, a lot of our members love to consume this as much as I do. And a lot of you guys actually have more time than I do because I'm busy doing these webinars, creating trade alerts. Okay, the YouTube TV app, another great application. I actually have 2 phones. The TV app can't be closed, so I like to listen to CNBC, Fox, and CNN. Once again, I want diverse perspective at all times. Okay, Twitter. Twitter can get a little too much content to you, so I'm hand selecting the most important people that can make or change the markets. And so this is at least the current list. It looks like Pete Buttigieg needs to be put on there. He's moving way up in the polls. Nancy Pelosi, McConnell, Kyle Bass, the long view. So I've got a number of people I follow. Trump, probably the most important, Zero Hedge. So I give you my Twitter list to follow from your phone. This is the easiest way to see what's happening each morning. The Bloomberg app, totally free. Who needs a Bloomberg terminal? I like to look at the currency market, primarily the Chinese versus the dollar, the yuan versus the dollar. Every time that devalues, we've seen stocks crash usually within minutes. So that's a great leading indicator. I like to look at the futures market. Not that that's going to affect our trades, just so I have an idea what's coming at us in the morning. And then I like to look at the commodities and the bond markets from the free app. So that's very useful. Seeking Alpha. If you want to get specialized information on certain companies, I actually track a lot more than we trade on Seeking Alpha. And primarily, I'm looking at other markets as a canary in the coal mine to try to predict problems. So we're looking at a few banks that might be causing this repo madness right now. And also you can create special lists. They give you specialized expert articles that match up with your tickers. So that's another good phone app. I like the Roku. It's the only software that will give you YouTube TV and YouTube. So I have this on every TV in our whole house, so I can plug in and consume content from nice comfy sofa chair whenever I have time. I like the Bluetooth speaker. You can see all my little gadgets there to keep educated. But yeah, I'm consuming probably 8 hours of content a day at a minimum to really be at the cutting edge of what's happening. So it's a mix of politics and economics that really make a big difference right now. And probably the geopolitical environment's more important than ever before with China. Get yourself a Bluetooth, go for a run, listen to your playlist. Now, it's not very convenient to read Zero Hedge or Drudge Report, the 2 main news sites I listen to, as well as Bloomberg. We'll take a look at that. For 3 totally different perspectives. Zero Hedge will get some reports from banks. I don't listen to everything on Zero Hedge, but when they pull the accredited investor reports that go out from big banks, definitely must reads. It's not convenient to read on your phone or your computer, but this FIRE product from Amazon. It's great. They have a thing that will kill all the ads and pop it up, so it's super easy to read. That's what I was reading the FOMC meetings on last night. And then finally, Bloomberg has some great newsletters that they will email out completely for free every day to you. And so these are the primary newsletters I like to follow from Bloomberg. America, Asia, Next China, and Bloomberg Politics. And so yeah, so that's what you'll get for free for 4 weeks. If you do decide to join us today, is our boot camp program. All right, guys, so that is the big picture. That's how we make the trades. Of course, I've simplified it to try to make this as easy to understand as possible. But, you know, a little finesse certainly goes a long way with improving the results. Let's see what other questions we have out there. See, Don, do you have any comments or questions? See your microphone.
No, you did a great job. Thank you.
How's your portfolio shaped right now? Is it, you got a uncorrelated basket that's protected, or are you being stuck?
I'm out of shape here, pal. That's why I'm listening to you.
Well, what do you got? You got a bunch of stocks or what?
Yep. Yeah, I'm way overweighted and all this stuff. So
Now, is it like a company you worked for that you just have been accumulating? Is it your favorite company? Is it a basket? Or what's your strategy there?
That's a lot of ETFs. I got about 8 ETFs.
Oh, okay. And do you have any?
But I have no downside protection.
No downside protection.
Other than CDs and cash. I mean, but that's not going to protect my investments that way, the other way.
So what's your plan? Are you gonna go Clint Eastwood and feel lucky, or you think you might try to protect your assets a little bit?
I've done that a few times in my life. I think it's time to probably get more level in the road, not shoot for the hip too much.
Okay. Do you feel like you're on the edge of joining our program, or where are you at?
Well, I've done this over the years with a lot of different guys, and it's never really been that great of a turnout for me. So I just, don't want to get burned again on some sort of thing.
So what would you say was the reason why it didn't work out? Were their trades just absolutely bad, or were you not getting the same?
Well, it always gets down to discipline about doing it yourself. I mean, that's always the weak link.
So let me ask you this: do you think it was your fault or their fault that you had bad results?
Well, I think the markets really changed. I was doing a thing with Larry Williams way back right before the crash, and I quit right on that Friday before the crash. It saved my ass. Otherwise, I'd have got blown right out of there. It was doing S&Ps and bonds.
Okay. So yeah, what's neat about so my experience was that, yeah, even if the guru had good results, the main problem was no one else had the same results. Either they just didn't get the trade, maybe they weren't very honest with the pricing, people couldn't predict when the trades were going to come out, they didn't know how much capital to put into it. So I think you can see with our program, we know exactly when the trade's released. We're all trading them at the same time. These are not small cap stocks where the price is flying around. For heaven's sakes, this is the S&P 500 SPY ETF, the most liquid product in the world. So I promise you, whether we're losing or winning, you're going to get very, very, very close to the exact same results we publish. And we've got about 150 members now who can testify to that. They get the same results, whether it's good or bad, because of the way that the products rolled out. Very predictable, very consistent. James has a question. Would you buy the VIX as a hedge? We have a profitable VIX position right now in our boot camp. So I do more advanced trades on Friday for our boot camp members. That ties into the big program. But for our basic advisory, we don't need it. We don't need it. All the returns you've seen are without having to do any kind of crazy hedging. It's not necessary. So we can use the option market to profit from an up move or a down move, and we can have the uncorrelated assets to do the big lifting for us. So that's the TLT and the SPY.
But Jason, you were just saying that when the SPY goes up, the TLT goes up, and the bond goes up. So they're correlated. They're not uncorrelated. So I'm
No. When stocks go up, bonds go down.
That's not what you. Yeah, that's not what you said earlier. That's not what you said.
Well, let's look at the charts.
No, I'm just saying that's not what you said.
Fine. Okay, so here's one of the first slides we had today. In general, because we understand what the Federal Reserve was doing, they've been lowering interest rates. Both assets have gone up over time. Okay, so in the big picture, both are going up.
Okay, so how do we buy the SPY and buy the TLT? And you said that they're uncorrelated.
But, so in the big picture, they both go up. But in the short term, look at this. So when stock fell in 2008 or 2009, bond market jumped up. Here, let's zoom in. Okay, so the SPY is in orange. The TLT is in the green and red. So what happened in 2009? Tell me, what was the maximum gain for the TLT in this chart? What do you see?
SPY was going down and the TLT was going up.
So the SPY went down 50% maximum drawdown, and the TLT went up almost 40%. Okay, so they're uncorrelated in the short term. So we can see that. Okay, so that's the whole point of all these slides. Now, you see them weaving back and forth?
Yes.
Okay, now they both traveled higher, right?
Yes.
Okay, so that's important if we want to be long the SPY and the TLT. But let me ask you this. This is your quiz. What happens when we get to the lower bound? Can that correlation continue?
Lower bound. Could you?
Okay, so the lower bound is what the Fed's this is what the whole world's freaked out about. What happens? So that pattern I showed you only works if the federal fund rate is traveling lower. And we can see that in this chart. So these are your different treasuries.
Yes.
You can see they're like a magnet tied to the federal fund rate. So the Fed is manipulating the markets. So this strategy where the bonds and stocks go up together only works as long as the Fed can keep lowering interest rates. Okay, but where we're at now is next to zero. So let me ask you this. Do you think the Fed is going to go to negative interest rates?
No.
Probably not, but we have seen, they're talking about it now, and we've seen Europe is doing it.
Well, who's talking about it? The POTUS or whatever? Yeah. I mean, yeah, he wants to for political reasons.
No, the Fed meetings that just came out yesterday, which we're going to spend 2 hours going through detail in our boot camp this Monday. We're going to read every line of it together.
Oh, that's
They're
exciting.
talking about it now.
Is that good? Is that a selling point to your program to read line for line the Fed, those old
the
morons?
boot camp. So the boot camp are investors who don't want to just get the fish on a silver platter.
Yes.
You want to actually be able to engineer this yourself. That's where the boot camp comes in. So this pattern is going to work for a little while, but not forever. And so that was the whole point of this, is that we're getting near the bottom of what they can do. They're at the bottom. They can go down 1.5% and they're at zero. And after that, there's going to be no reason to think that bond prices will go any higher, unless you believe they'll go negative. So they realize that and they're freaking out. They're trying to figure out, what are we going to do when we get to zero? Because they know they're in a trap. There's no way. Let's look at this.
Yeah, it's like, what do you do for an encore?
Yeah. So watch, let's look at where we're at and what we tried to do just recently.
I just refer to them as a bunch of junkies, you know, that need their fix.
So they tried to raise rates and they got, how far did they get up before markets crashed in 2018?
2.4.
Yeah. So they know that every recession in the past, they had to cut rates 5% and then do QE to save the day. What are they going to do this time? And then just think about it. You know, if you can borrow money for free, do you think you're going to make smart decisions with how you spend that money? Probably not.
No, it'll probably become over levered again, like it was in 2008, 9.
It already is. Look at how much more over leveraged we are now in the S&P 500. Let me ask you this. Do you think the value of companies has doubled since the financial crisis? Or in
No.
fact, if this was the real value at 80, you think it's tripled? Are companies making 3 times what they were just 10 years ago?
No,
So,
no. When you have a Tesla that's selling for $300 and some odd dollars and a Ford's for $8, and nothing against Tesla, it's a great car, but there's a lot of competition coming in. That's, yeah, no, there a lot of the companies are overvalued, huge PEs and a lot of negative PEs.
yeah. Well, yeah, we're in a world where, so if I can borrow for next to nothing, I'm now incentivized to borrow as much as I can get my hands on and then go sell products. But now I'm not really concerned about making a profit. Now I'm more concerned about revenue instead of profit so that I can get more debt. So they're out, you know, look at Netflix, look at a ton of companies like Uber, they're losing money. They're not making money, they're losing money at rapid pace. Now, do they have great revenues? Sure, but they're losing money. You know, if I can sell 100 hot dogs at 10 cents a loss, I lose $10. Well, you know, why would I want to go sell 100 million hot dogs at 10-cent loss? It doesn't fix their problem. And so that's the world we're in. We're in a trap. They're going to go to zero. And then what? And so that's what they're talking about now. They're talking about what are we going to do when we get to zero? How are we going to keep this financial system working? And so now they're talking about essentially putting a cap on the yield, which means they're going to have to print a ton of money. So you want to have your gold. But we're a little ways out. So how long could it take for them to drop this to zero? If we have a trade war, they're going to get to zero much quicker. So that'll speed up the timeline. That's why I think China is very incentivized to press us to create a trade war and to escalate. Now, let's say for whatever reason, they're just in such bad shape, they don't want to do that. Well, they're still trapped, but maybe they can draw this out for a couple of years. So
They sure have a lot of our treasuries. Just start selling that.
well, so yeah, they've blown through. That's the last thing the Chinese want to do is run out of dollars, because no one wants the yuan. The yuan represents 1% of, you know, nobody trusts China. Money comes in, you can't take it out, and the value of the yuan is depreciating while the value of the dollar is appreciating. So they've blown through $1 trillion. And I think they have like 2 trillion left. So that's what they use to buy all goods. They're a huge import. They're the biggest import. That's been the whole growth engine for not just this decade, the last 2 decades. For emerging markets to grow, they rely on China. And the problem is they're not growing, they're deaccelerating. So they went from 14% GDP 5 years ago to 6% this year, if you trust their numbers.
That's if you trust. Yeah, I was just going to say that. If you really believe that, yes. Mm-hmm.
Yeah, so
Could be a smoke screen.
So they need dollars, and that's going to become a big problem for them, is that they really need dollars because no one wants to trade in the yuan. So, so I doubt they will,
sell the treasuries. Yeah.
Yeah, all they're doing is they're letting them roll off and then spending them. So, but yeah, they certainly, Russia and China have stopped buying treasuries. So, and that's their way to put some pressure on us. But at the end of the day, they need dollars. That's the world. And plus, that's why we support the Middle East so much, is because the only reason we do that is because the agreement is they have to sell the oil in dollars. So now the whole world has to own dollars to have access to oil. So that's how we can keep this whole bubble going for the U.S. debt, at least. It gives us a tremendous advantage. And so, people have been calling the end of the dollar for better part of 3 decades now.
But it is a house of cards.
Yeah. So what happens if we go to the zero bound, we print, we push the balance sheet up another $5 trillion. Ooh, that's bad for the dollar, So at some point we have to cut our deficit. We need to raise rates and we need to keep the dollar strong. And that's going to come at the cost of the stock market and bond market pop. And it's just that simple. Now, how long will they try to Japanify us? It may be until we get the right political leader in there that says, all right, let's do it. This one currently obviously doesn't want to pop any bubbles. He wants to get rates to zero, and he knows how to do it. Escalate the trade war, rates go lower faster. Debt goes up quicker, GDP looks good, the bubble expands. So my bet, and again, I'm not playing our portfolio on a speculation. Okay, we're playing it safe. We're waiting for the facts to develop, and then we're reacting to the facts. So right now, we're in a very hard spot to lose, but we're giving up a lot of profit because we have these put options that cost so much. But when the market does react to one or the other, our put option will reduce losses on either the TLT or SPY, and then the other asset's going to fly higher. And so we're waiting for either positive or negative outcome in the trade war to really generate some substantial profits. Now, we've been squeaking out some good gains in this period where it's a toss-up. What's going to happen? We don't know. We've done great for having such a ambiguous market. But as soon as it is clear what's going to happen, our ability to predict the moves will be far easier, and we should be able to get back to some healthy, our best return was about 3%. So, so that's kind of what I see coming for us.
That's until another geopolitical bubble pops. So whether it's Brexit or who knows what's coming down the pike. Yeah,
for sure. But right now, if you just focus on the U.S.-China relationship, that's the big geopolitical event that's going to shape the markets. And so that's where I spend the majority of my time, is focusing on that. Now, will that always be probably for the rest of both of our lifetimes, and I'm a lot younger than you guys, almost without question, these will be the two, every time in history when you have an up-and-coming challenger that's trying to take the lead against the current leader, you get a battle every single time. And so that's what's happening. U.S. is recognizing that they essentially fed China to become a giant, and now China's trying to take over. And so if you think they're going to just let them do it without a fight, I doubt it. I highly doubt it. Last time anything similar to this was with Japan, and now Japan GDP is crushed, and their stock market's been flat for 3 decades. So will this lead to World War III? Who knows? Maybe. It's a scary thought. Oh, shoot. Dean, I didn't realize your thing wasn't unmuted. Dean, you there?
Yeah.
You got any
So-
final notes for these guys? We kept them on here for 2 hours and 20 minutes. Good job. I hope you guys learned a lot. We'll let Dean say some final words and let you guys go.
Yeah, team. Just definitely save my cell phone number. It's 505-322-7515. If you have any additional questions after going through the webinar now, feel free to reach out to me. I understand some people like to talk more in a personal setting in regards to capital and their strategies and their current portfolio and that type of stuff. Would love to go through and look through your portfolio, see if you may have a little too much risk, or if you have just way too much cash on hand that's going to get eaten up by inflation. And real inflation, depending on where you are in the country, is about 5 to 7.5%. Outside of what the government says is in their numbers that are absolutely worthless and useless to the economy. But yeah, would love to help you answer any questions. Would be more than happy to share my experience with you following the system. And if you'd like, be more than happy to put you on with one of our other clients as well. I do have approval from, I think it's 26, 27 clients now to actually touch base with them before someone else joins, if you're interested in that as well. So, and one thing I would challenge you to do is, look at where the SPY was, 07, 08, and look where we are now, and maybe deeply ask yourself, is this the best time to just just be hopelessly long the stock market? I don't think so. But it's good to kind of look through some history there, and yeah, it's we're up over 400. I think we're close to 470% now. So yeah, it's and really, if you're over 60 years old, I think you'd be really hard pressed to find anything that's safer for your hard-earned capital than this system. And heck, I'm enjoying the heck out of it. I have a significant amount of capital in it, and I'm only 35. But if you guys have all ever seen Moneyball, Brad Pitt has an excellent line in there, and he's a baseball coach. He said, I hate losing more than I love winning, and that could not be more true for myself and for my hard-earned capital. So I think that's really, kind of the gist of the system, and really showing how investors to kind of re-engineer how they think and take a defensive approach to your nest egg. I mean, we all have worked our butts off, to collect it. So the last thing you want to do is lose it quickly.
Very good. Thank you, Dean. Any last questions out there, guys, before we let you go? All right. Well, it's been wonderful to have everyone on the webinar. I will throw out that on Wednesdays we do our paid webinar. So if you want to dive even deeper than this presentation, definitely join the program. And if you want to go way deeper, that's what our boot camp's all about. So we take you through a whole lot more education than just this. So thank you everyone for your time, and hopefully we'll see you on the inside soon.
Yep. Thanks, folks. And just don't forget you do get a free month to our $10,000 boot camp if you join today with the annual advisory membership. So definitely awesome to take advantage of, and a nice way to really learn more about the system and the front side of things when things are kind of probably still maybe a little bit newer for you. So yeah, give me a call, and we'll get you connected here and get your portfolio in a more defensive, more than likely maybe a little bit more intelligent setup for this cycle of the bull market.
Thank you, guys. Until next time.
Thanks, Jason. Thanks, team, for coming. Appreciate your time.